Thank you, banks, for screwing up so royally that the Fed became more circumspect about raising interest rates, allowing tons of money to flow into big-cap tech stocks that can thrive in a slowdown. After all, a bank fiasco would lead to a tightening of credit that might be equal to as much as a 100 basis point rate hike, maybe more. And that's what allowed the quarter to finish that strong. It's why we did okay today, too. Dow gaining 327 points, S&P advancing 0.37%, NASDAQ declined 0.27%. Now, I wish I weren't being serious. I wish the banks could somehow negotiate their way to investability. But they just won't comply. They're too opaque, too hard to understand, with too many terms of art, too much abstruse accounting, and perhaps most of all, too many darn ways to make mistakes. The banks, frankly, have become the pariahs of this market. They're only as good as their weakest link, even if that link is a clown show called Silicon Valley Bank. Or to put it another way, this industry is so crazy that even the one bank everybody trusts, J.P. Morgan, has made its share of mistakes. Yep, J.P. Morgan may be the best house in a neighborhood.
The house of pain.
That seems to get boarded up or blown up every few years, with the regulators always one step behind the tsunami. Sure, there are others that I like. Colin Frost was on from Texas, Huntington Bancshares in Columbus, Ohio. Yet it really doesn't seem to matter to their stocks, does it? Either through ETFs or homemade derivatives, the banks all tend to trade together. And right now, that means they tend to trade badly. But let's not speak too ill of the banks, because what they did was hasten the downturn that never seemed to be able to get off the ground. A downturn that won't be defined this time by layoffs, but by an inability to get credit, whether you're a small business owner or just someone who might want to buy a car. We've all been waiting for the Fed's rate hikes to cool down the economy. It hasn't worked. Problem is, they really haven't done anything to be able to keep salaries under control. It's not enough to get inflation just level. We need to see wages actually come down. Now, sure, we got legions of Silicon Valley layoffs, but the tech industry tends to be very generous to people they let go. Do you really count as laid off if Meta's giving you 5 months full pay? Feels more like a paid vacation. If that person double dips, she could be a millionaire by year's end, and most of the engineers and programmers are still so highly sought after that it's easy for them to find work. Sure, we know the startups that got hurt by the closure of Silicon Valley Bank, they had some layoffs. Seems inevitable, but it hasn't in any size been noticeable. The only thing bigger than the cash hoards of these venture capitalists is their egos. The outstanding hubris per share here makes it so they'll keep funding their pearls rather than admitting that they're swine and moving on. Look, to their credit, they had to put up with this abandoned unicorn rap for ages. But then the queue burst open so wide that all sorts of flotsam and jetsam came public. It seems that the only disgraced Theranos is the one that didn't make it through the chute. Believe me, if we're up to the Craven investment bankers, they simply would have said, wait, why don't we just put a sticker on that Theranos prospectus and say, hey, we're still working the kinks out, and then get all the best clients to take them down if they wanted to get what's hot coming after. So what will the slowdown look like now that it's coming from a banking crisis rather than directly from the Fed's rate hikes? Well, this is what this quarter is going to bring. First, there'll be a backlash from the newfound prudence of the small, medium-sized businesses that were once the mainstays of the regional banking business. No law firm, no doctors group, no accounting firm can keep more than $250,000 in any one bank without being sued by someone if that bank collapses and deposits go uninsured. Those are bedrock deposits that are being lost right now by depositors who never really thought of their bank as possibly being in trouble, never checked the bank's balance sheet, for heaven's sake. Of course, the bank probably really isn't in trouble. But unless each small and medium-sized business is swapping around to another bank and vice versa, there'll be some skittish regulator saying that he wants that bank to make fewer loans until this is all cleared up, whatever this actually is. So a home buyer will have to put up more money for a home, which means less money for Sonos or Best Buy or Williams-Sonoma or RH. So a car buyer might have to say, sorry, I can't buy a new car when the cost of financing is double within a year. She'd just rather just keep that jalopy and throw some money at it. So someone who wanted to take a big trip overseas is now visiting Yellowstone in a camper. Nothing wrong with that. My daughter went glamping all over the country. But the simple fact is the glampers don't make the economy go around. Now, today we saw the aftermath of the wild week we just finished with an insane amount of money piling into tech. So much money that it moved up stock prices and brought some better performance for those fortunate enough to lead the charge into the group. That money is now being unwound, which is what happens after a big phony romp like we had. There was a ton of money today that went into oil on a surprise 1.1 million barrel production cutback from OPEC Plus, causing OPEC Plus is like Disney Plus, is that Paramount Plus? OPEC Plus, causing people to wonder why the president didn't stick to his guns and replenish the drastically depleted strategic petroleum reserve at lower levels when he had the chance. Now, I think that money's going to go back out of the oils, okay? Because I don't think oil has much going for it on the demand side other than China, although China could be very big. But for the most part, today was a day when some money went toward the drug stocks because of the aftermath of the bank disaster, and some money went toward plain old industrials that do better in the late stages of a Fed tightening cycle, especially after these 3 failed banks may have caused an imputed 100 basis point rate hike. Got to thank the knuckleheads of Silicon Valley Bank and the ne'er-do-well bank examiners for letting that happen. Or maybe we just give them an attaboy for making it so effectively we got 4 steps closer, 425 basis points, without having to have them. Yes, to that closer to the end of the cycle, because they were too incompetent and too timid and too terrible at their jobs to catch and stop the bank run heard around the world. Oh, and the Cramer Barrel thing found a good sectional, cost a ton, made her happy. Actually had it in stock. Can you believe it? In this world of screwed up supply chains, just being able to buy what you want immediately is borderline miraculous. Bottom line, if the Fed's really almost finished raising interest rates at this point, we got the foolish regional banks to thank for creating a situation that's made the stock market a lot more attractive than we thought. Oh, also thank you, bank examiners, because this early into 2023, who'd have thunk it?
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.